Hi, good morning, everybody. Thank you for joining in. We have Naren Kini sir with us, who will be taking over the session. Thank you so much for your time, for tuning in. I welcome you all. Yeah, over to Naren Kini sir.
Yeah, good morning to all the participants, and thank you for registering and participating in this webinar. This is a webinar we are conducting as an educational series, and this is happening at a time when there are so many questions passing our minds with the market not being doing well since the last 6 months. So with this, we have three topics in this webinar. It's a very short, crisp 1 hour webinar. We are covering three topics in this, and each of the topics will keep about 12 to 15 minutes, and we'll have about 20 minutes kept for the Q&A. If you have any questions, kindly type it out in the chat box. We will group them in the same order, topic wise, and myself and the other speaker, Mrs. Vidyakini, will attend to the queries. With this, I'll start the presentation. Just a It's an introduction. We have participants who are our esteemed clients and also others who are interested in investments and taxation. For the benefits of others who do not know us, they can always look for details on our website. In a very crisp nutshell, First Assetz is a Bangalore-based multi-family office. We have a financial product distribution as well as an arm to service the SMEs to scale up their business. We are a highly experienced investment and banking background team. We have been serving about 400 plus clients, especially the HNI clients across India and overseas. We founded this First Assetz in the year 2016. It was founded by me, that is Narayan Kini. Before starting this in 2016, I was working as Senior Vice President at SBI Mutual Fund, Mumbai. This is a brief introduction about ourselves. And coming to the topic number one, which is about understanding the cash flows, risk, and return. This is something very, very basic, but at every time when we have questions regarding our investments and portfolios, we have to always come back to the drawing room, and that is where we have begun our investment journey. So I would start with a very simple table. This is to understand our cash flows. These cash flows are meant for individuals. Many of our clients, especially the young clients, when we onboard, we take them through the Excel sheet where they go through this exercise and they arrive at their cash flows as well as the cash outflows. This is a very simple tabulation. In this tabulation, I have put the occurrence of income, that is the cash inflows, and the occurrence of cash outflows, that is the expenses, and our control on these cash flows. Whether do we have a control or we have lower control on this. So currently, if you are a salaried, you are working on a cash flow statement. You will have a salary where you have the occurrence, which is quite high, that is a monthly, and you have a control on the inflow because this is coming to your account every month. Similarly, the rent and the interest, pension, depending upon what kind of a client you will have control on certain controls on your inflows and also the expenses, which are largely the expenditures related to household, rent, transportation, premium, insurance premium, taxes, all these things. But there are incomes, which are also not coming to us quite often. They have a frequency which are low to moderate. For example, if you have a capital gains that may not occur every year, or if you have some gifts or inheritance coming to you, which may not happen at all the time. So these are also the cash flows. but then you cannot predict when those things are going to take place. And also you have very low control on the occurrence as well as the inflows. Similarly, we have the expenses like travel and leisure, investments, capital loss, medical expenses, disability and death, and also the charity, etc. But what is quite important for us to understand is when we have the surplus, that is, our expenses are lower than the income, that is where, we have savings begin to get accumulated. So when we have the savings, which is earnings, which is more than the spending, that is when the investments come to our mind. So the investments are not a simple activity. It is where we commit our savings with an expectation to earn more. That is where the investment comes to our portfolio. For example, depending on my cash flows, if I have a immediate requirement or I need to keep the funds at call, I may invest in liquid funds or I may keep the money in SB accounts. If I choose to keep it in a very short term, my risk is very low as well as the returns. Similarly, if I keep my funds for relatively a longer time, like 90 days, my risk is still low and the returns are also low. And if I need, look at investing it for more than 2 years, maybe I still can keep it in the FDs or the short-term funds, where my risk will move from low to moderate. Returns also will move from low to moderate. If I have funds available for an indefinite period or a much longer period, it can end up in being in the FDs or in bonds or in equities, depending on your risk profile, or maybe in real estate or any other assets you may like, where you want to lock in your investments for a much longer time. So as we start investing it for a much longer time, our risk will start moving up from moderate to high. And also the return starts move up from moderate to high. Therefore, when we invest, we assume certain amount of risk. Therefore, it's very pertinent for us to understand risk always is a known certainty. But most of the time we feel the risk is uncertain. It is not so. Risk is a known commodity. We know the risk associated with the investments. But what is not known is when the risk is going to surface. The risk can surface at any time without notice, and it can be a financial risk, liquidity risk, a business risk, or an exchange rate risk, or political risk, or some other risk that we have not envisaged. Therefore, we need to be very, very clear on our cash flow status so that we determine our asset allocation. Asset allocation is a very important exercise we do, wherein it's not only the risk appetite, behavioral behavior related to the risk or the tolerance for the fluctuation. It is also the fund flow. That is very, very important. Therefore, now we have three components, which is a cash flow, and the second is the risk, and the third is the return. And the fourth, that is obviously how long. So these components, once we understand, it becomes easy for us to choose an investment product. And those products could be FDs, short-term funds, long-term bonds, or the equities or other class of assets. Therefore, what I've tried to do is, we have tried to keep it in a table, how our cash flows or our returns likely to come from our investments. To keep it simple, we have just kept SBI FD rates, which are quite safe, and the government securities, again, backed by the sovereign guarantee. And, the equities, which is a Nifty mid cap 150, Nifty small cap, NSE emerge. NSE emerge is typically a SME investment, and also the BSE IPO. This is also the SME segment. So we have kept the assets which bear a different risks. So when you look at this table, the table looks quite okay because the FD rates are constant or little bit varying here and there. GSEC also will have variation as per the MTM, that is mark to market, and the equities start giving you a different returns. This is done on a calendar year, Jan 1st to December 31st. So if you see, the returns move from negative to positive territory. And to understand this, when these things are happening, we are earning this, a lot of disturbance come to our mind because there will be a market volatility and there's a lot of noise from the market news and other social media. So if we plot this table in a graph, the same returns which we are arriving at on a monthly annual basis looks like this. This is the kind of volatility we experience on a annual basis or on a daily basis or a monthly basis. So this is the kind of noise we have. If you see the most wild swinging investments, that is the SME investments. It almost looks like a M because it goes from negative territory to the highest positive territory, comes down and again goes up and then again comes down. Similarly, the next line is the NSE emerge, and below that is the small cap funds. Sorry, the small cap market, Nifty small cap 250, and below that is the Nifty 150 mid cap, and below that is the G6, and then the FDs. So if you look at this graph, you will see each of these segments are behaving differently with a different risk, and these risks are plotted, and the table does not actually signify this kind of a risk. And therefore, we thought we should share with you the kind of volatility you face on a daily or a periodical basis. Now let us try to plot these returns as a accumulated returns. If we plot the same returns on accumulation, every year the market starts growing, your wealth also start growing, or it gets depleted to the extent of erosion in the valuation in the market. Similarly, the FD interest, we have replowed back to the deposits so that the interest rates, the FD also grows. GSEC, we have not accumulated, we have just allowed it as it is so that it remains mark to market, and the interest, we have shown it, we have taken it as consumed. Whereas the growth we have made, the accumulation, what we have done on the other equities, that is Nifty 100 and mid cap, small cap, we have just allowed it to accumulate over the years. And this tabulation also does not signify much to you, but when we plot this on the graph for the next 10 years or the last 10 years returns, when we plot it, it looks like this. It looks quite harmonious. The returns which were showing so wild between the year with a lot of negative and positive territory starts looking very harmonious and very peaceful with a linear tendency, except the SME graphs, which are the line 1 and line 2 above. All others starts looking very, very linear. That means from a non-linear return over a period of time, if you have stayed invested for a long time, it starts giving you a linear returns. In between the safest investment of deposits or GSEC and the small cap, you have a difference of about 8 to 13% on an annual basis. Therefore, the point we are trying to drive is that the investments when you make in a riskier asset, especially, you have to stay committed for a much, much longer period. And the volatility is the nature of the investment that we have understood before investing, and we have taken the journey. Therefore, the volatility is a part of our investments, and we'll have to tide over this volatility with a longer term of being invested. Therefore, I just wanted to also share with you how these returns have surfaced, or we have got these returns over the last 10 years, because none of the segments give you the same returns every year. Every year, one or the other segment takes over. The colors which we have given is small cap orange, mid cap blue, and large cap is green. That does not mean that they are the thing. But what we'll have to look at is the row one. The row one on the top gives you for the respective year which is the segment which has given the highest return. For example, in 2015, the small cap gave 11% return on an annualized basis. This is point to point from Jan to December. In 16, mid cap gave the highest return as a segment, which was 7%. Similarly, in 17, small cap came back with a 58% return, and the mid caps 56 and large cap 33. If you keep observing these moment of segments, none of these segments remain at the top every year. Sometimes you will have the same segment on the top of the table. For example, currently, if you see, our small caps have given the YTD return of minus 18.31%. This has happened in the last 40-45 days. Small caps has given an absolute negative return of minus 18.31. This is as of yesterday. And the mid caps have given you a negative return of minus 13.22%. Large caps are down by about 5%. Whereas in the last year, if you see, the small cap had delivered 27% return, mid cap 24, and large cap 23. Large cap 13%. So that means to say that whenever the certain segment underperforms in a year, it comes back and compensates for the time it has spent not earning you in the prior years. For example, 2023 and 24, small cap delivered the highest returns, and in 2025, there is still YTD. It's already lost about 18.31%. This is the nature of the investments. So I've also explained you through our earlier slides that this is the nature of the investments which we have made the allocation, and hence if we stay put for a longer time, we tend to get the returns which these segments have lost in the prior year. The subsequent year, they make good if you are patient and stay invested. So with this, I will move to the next slide. So this market volatility, as I said, is a integral part of this investment when you decide to invest for a longer period of time. So every time we come across this risk or a volatility, what we need to do is just to sit quiet and recall and ask these 3-4 questions that will address most of your apprehensions. The first thing I'll ask myself is, am I cautious at this time when there is a volatility happening in the market, or have I become pessimistic? This is very, very important. I can become pessimistic because of a lot of noise that is happening in the market. The secondly, I'll try and ask myself, why did I decide to invest in this risky assets? There was an intent, there was a purpose for me to allocate these investments to the risky assets. That could be for returns, or that could be that you don't need money for a much longer time. But I had understood the risk, and therefore my intent was to invest for a longer time. I don't need a cash inflow, and therefore I wanted to take the risk, and hence I decided to invest. The third question I'll ask myself is, what are the reasons for this volatility? Why this volatility is taking place? For example, currently it is a overvaluation and a lot of exodus which is happening from the FIIs, and therefore and the dollar appreciation which has taken place. Is that going to affect my investment? Is there a problem because of the the growth in the economy within the country? I'll have to ask sub questions to see if my investments are going to be doing good in future or not. So Another good thing, which I can cross-check my tolerance to the risk. How did I react last time to similar situation? Because this is not a first time we are facing this situation. In the past also we are faced. For a first time investor, maybe there is a much more advice and a handholding required from his advisor. Otherwise, for the seasoned investor, he has to just ask a question to himself: how did I react to the similar situation in the past? Because we may have faced a similar situation in 2018 with our portfolio, or maybe in 2008 in our portfolio, or in 2016 to our portfolio. But as recently as 2 years ago, I'll just take you back to the slide. As recently as 2 years ago, in 2022, our portfolio didn't do that well. 2022, the large cap gave us 5%, mid cap gave us 5%, and small cap gave negative 3%. And in 2018-19, also, we had a very muted or a negative low returns coming from the market. So, but these memories will not last long once the market starts moving to the positive territory. And therefore, I come back to the very important question, which is the cash flow, because that is what is important for us to remember how long I plan to invest. If I had planned to invest for 10 years, 15 years, I should not worry about this kind of a volatility that comes quite often. But sometimes it so happens that I may become more cautious, or I become extremely pessimistic about my investments. That time what I need to do is I decide to take the money out of the market. When I take the money out of the market, I need to take the question again: do I need my funds even if it is incurring the loss? Because now if you are removing the funds from the market, one is that you will have a loss. Second, you have another reinvestment risk. Where else do you invest? So therefore, this volatility in the market, which throws you the risk, and the risk which will leads you to the asset allocation, and the asset allocation which has how long you want to invest. These things have to be seen together so that you have a peaceful investment done. So therefore, I would like to conclude this session with a summarizing. Every year there was a correction. Indian equities have tripled overall over a period of 10 years. So every 10 years, if you see, you would have tripled your investments. And during the last 45 years, 36 years ended up in positive results, despite a correction between 10 to 20%. And the mid caps have corrected more than 15% every year. And 3 out of 4 years, it has ended up in a positive return. Small caps have corrected between 15 to 30% every year. And 3 out of 4 years, it has ended up in giving a positive return. So this is how the markets have been behaving, and they tend to behave the same way. It's very difficult for us to predict, but this is the nature of the behavior of the market. Therefore, mere focus on volatility may result in untimely exits and entries, and you may end up in not achieving your desired goals if you are jumping in and out of the ship. For example, as a analogy, I can just tell you, when we are airborne and we are traveling in a aircraft, we are aware that there will be some turbulence, and sometimes the turbulence can be very severe. When we have a turbulence, we don't think of jumping out of the aircraft. We fasten our seat belt, wait for the turbulence to get over, and the aircraft to find the equilibrium. And the similar thing happens with the investment, riskier assets. There will be a turbulence, and over a period of time, the markets will find equilibrium and they find a direction. Therefore, the risk is, if you are a very, very safe investor, you simply do not want to take any risk. You always tend to keep your money in a fixed income instruments or a high safety investments. What happens is, you bring in a new risk to your portfolio, the risk is the inflation and the taxes. Let us say I have a portfolio which is completely zero risk. I have kept everything in either GSEC or in FDs. What happens to my portfolio is I get an interest on which I'm going to pay the taxes, and I also have inflation. And let us say if I'm getting a 8% return on my FD portfolio, which is considered as a safe investment, and if I'm, let's say, on a 20% tax slab, I paid 1.6% as tax, so I'm now at 6.4%. And if my inflation is, let's say, 6%, I've earned only 0.4%. As long as my interest net of tax is above the inflation, it's fine. But if my rate of tax is still 20% and the interest rate is 7% and the inflation is 6%, I'm in a negative territory. So over a long period of time, my investment portfolio may have just eroded or depreciated, and I may not be able to sustain my uh, um, cash inflows subsequently. Therefore, it's very important for us to understand cash flow requirements for short, medium, and long term, and also look at one's asset allocation, which is in harmony with the risk appetite. That's very, very important. If your portfolio is not in harmony with your risk appetite, then what happens is it brings in a lot of unhappiness to you, and instead of building a wealth, we may end up in losing our wealth. So therefore, every now and then you should be in contact with your advisor or review your portfolio and harmonize the risk which is built into your portfolio, and stick to your basic question: when did you begin investing? What were your intent? And if the intent has not changed, stick to the investment for a long, long time. And you will definitely see your portfolio has made very good returns, and you have been able to build a good wealth. So I come to the topic one. So this is a disclaimer. This webinar is a part of the educational series initiative. The purpose is not to make any solicit business this or make any advice. This is only a pure educational series. We are not making any guidance about personal taxation to buy or hold or sell the investments. So please take your informed decision, consult your advisor, and take the necessary action. With this, I've come to the session one, and I'll move to, I think I'm on time, it's 11:25. I'll move to the second topic. This is on the SMEs.